Welcome into Phil's Tax Hacks and Other Retirement Facts with CPA and personal financial specialist, Phil Putney. Now let's get rolling with today's show. Welcome into another edition of Phil's Tax Hacks and Other Retirement Facts. Phil, let's talk about tax season a little bit, my friend, since it is really upon us.
That time of year. So yeah.
Tax mistakes new retirees make. That's kind of maybe a little bit more the focus point. So just kind of thinking about if you're new to this whole experience, which it's a big change, right?
It is, absolutely. Yeah, especially from a tax standpoint, if you've not done any planning and kind of look down the road a little bit to see what might be coming. So
Exactly. So look, nobody likes tax season, right? I mean, that's a given. Like we're all like, oh man,
that time of year again. Yeah.
Right. But we got to deal with it, right?
Yep.
So we're going to talk about this Kiplinger article. I'll put a link in the show descriptions down below for people who want to check it out. Some biggest tax mistakes, retirees make. Again, based on this article conversation. And so we'll start with the RMDs, because ignoring those or whatever, maybe doing the delay thing and then taking the second one or, taking, two the next year. So let's just talk about some of the tax issues that you see, as well as the article's conversation a little bit. So let's break this down.
Yeah. So, I mean, this is where people get caught off guard if they haven't really done proper planning for retirement, because they haven't looked down the road. They enter retirement and realize that, or think, I should say, that they're in the lowest tax bracket again. This is great. I'm going to be in this low tax bracket retirement. Well, what they told me is true. This retirement thing's great. I mean, it's funny. I've way back 15 years ago, I think now or something, I wrote an article for the Wall Street Journal that talks about what I call the tax tidal wave, which was exactly this scenario. A client of mine that I had met with back then through a class hadn't looked down the road, and he did his own taxes, and he was in this time of year, that first year of retirement. He was thrilled because he was back then the 15% bracket, and he hadn't seen that in 20 years. So he thought retirement was great. Well, I had to ruin the fun of it all and said, okay, well, let's take a look what it looks like just a few years down the road once you hit RMD age. Back then it was 70 and a half, and all of a sudden his taxes more than quadrupled.
Ouch.
So it's one of those things that you better be aware of what this looks like and take a look at it today with obviously some projections. We don't know what it's going to be for sure, but at least get an idea, right? It's going to head in that direction. Don't get blindsided by it. So.
Yeah. And so, obviously to your point there a second ago, they've changed the rules, right? So currently it's 73. It's 75 for anybody born after 1960, right? Yep. So, you want to make sure that, especially if you're a new retiree, if your advisor is not talking to you about this, you need to make sure you ask about this. This would be a big faux pas. And you want to make sure, because the tax, they lowered the penalty, but they're more sticky about applying it. So you still want to get it done, because it's still hefty at like 25%.
Oh, yeah. You still don't want to miss an RMD, and at the end of the day, you still have to take it, pay the tax, and pay the penalty. So it's not like you're missing anything or, avoiding anything. So, and it's, just the pure planning of it, that once if you've retired prior to the RMD age, once those years have gone and you've not taken advantage of them by doing some Roth conversions or other tax strategies to help minimize and look at your lifetime tax and maybe move some of it forward. Once those years are gone, they're gone.
Yeah.
Right. You can't go back and recapture them. Once you hit 73, 75, your RMD age, there's no going back. It is what it is at that point. Now you still can maybe do some planning going forward, but it's a much different scenario than what it could have been. So. Yeah.
Well, and so we'll kind of step into that next one with this piece. Again, we're talking about tax issues for new retirees. And people will say, well, how can I avoid it? How can I get away from it? How can I not do the RMDs? Well, you can't, right? You have to do them unless you do some Roth conversions ahead of time, right? And so you take them out of those accounts that you would have to pay RMDs from.
Correct.
And that would open the window to making sure as a new retiree you don't do them wrong.
Right. Well, and this is the good and the bad of Roth conversions.
Okay.
I've been doing Roth conversions with clients for 15 years or more.
Right.
It's just part of my DNA. Tax planning is always part of what we do. We look at everything through that tax lens. But Roth conversions over the last couple of years have really gained some momentum and some recognition.
Well, tax lows, right? We're in low tax rates.
Right, which is a good thing. I mean, I'm glad to realize people are finally maybe looking at this. My concern with it, though, is that it's become a marketing tool. Every advisor out there is now grasping onto this concept of Roth conversions, and all these, insurance companies, annuities, investment companies are all coming out with their own calculator and, this is what you should do. And, and
well, buzzwords, Phil. I mean, we love buzzwords as people, right? So, yeah.
At the end of the day, you have to understand what you're doing, not just put it in some calculator and have you do this conversion when at the end of it, it's probably the wrong conversion. You haven't looked at that big picture. I mean, there's this big push for, get you to the 0% tax bracket. That to me probably says you've done way too many conversions, depending on your scenario. I mean, there's some clients that it might make sense to convert everything into a Roth, but for most, probably not. So you really have to look at the scenario to see what is my goal for my lifetime taxes. And there's all sorts of objections with that or objectives with that. So bottom line is it comes down to, if your advisor isn't walking you through, here's some options. If they're just saying, hey, we need to do conversions at this level today, or we need to, bracket bump, fill up that bracket. I mean, there's all these different concepts out there, which sound really good, but ask your advisor, well, why are we doing that? What is the long-term effect of it? How does this play out, at the end of it? So
yeah, and the bracket bumping is typically where it is, I guess, useful, right? But again, you don't want to go crazy either.
Yeah, so, it's one of those. It's a balancing act, right?
Yeah.
You're in the 22%. Do you fill up the rest of that bracket? Kind of the concept of bracket bumping. Well,
right.
Yeah, maybe that's the right thing to do. But the reality is the next bracket's only 24, so it's only 2% more.
Right.
And it's a much wider bracket, so you can get more converted. So it's this long-term big picture that you have to look at. That does it make sense to do more conversions early, quicker? Yeah, it cost me 2% more in tax.
Okay.
But there's all sorts of other things that play into it too. And IRMA is one of them, right? So the extra cost for your Medicare because of income, and Roth conversions counted as income. So I mean, if you're stretching out these conversions, are you pushing yourself into an IRMA bracket for longer, versus do we do it quicker?
Right.
Maybe push you earlier into higher brackets, higher IRMA thresholds, but it's for a shorter period of time. I mean, that's where you've got to run the math on these scenarios and look at, here's option A, don't do anything, just let it happen. Mm-hmm. And then let's start looking at option B, C, D. So you understand the pros and cons.
Right.
And strategy around it. And then it has to be fluid because things change, tax laws change. So,
well, with the IRMA thing too, right? Since that's a 2-year look back, you've got to consider that in, right? Because it's going to, if you did a bunch of conversions at some point and in 2 years from now, when IRMA looks back, that's going to hit you with a bill you weren't expecting. Right.
So the great scenario with that whole concept of IRMA and, going to the next bracket, I've got several clients that are still working, that we're doing conversions, but we bumped it up to the 24% for them. It made sense while they're working because it's a much larger bracket. In the thought behind it is, hey, we can get some conversions done. It costs you a little bit more, but when you retire, that's the one exception to the IRMA penalty that we can basically go in and tell them, don't look back at the prior years. This is what our income is going to be. So it kind of wipes away all those Roth conversions we did from IRMA, at least.
Gotcha. Okay.
So there's all sorts of concepts and things you have to understand when you're getting into Roth conversions. It's not just, it's a great idea,
Yeah.
Everyone's looking for it. So I'm going to start, talking about bracket bumping and all these things that you really haven't looked at the big picture. It's one piece of the big picture, very important piece, but
yeah. Like everything in retirement, right? I mean, it's all kind of interconnected to a degree, because you were just talking about Social Security and IRMA, and another piece on my list about, new retirees is the whole, Social Security taxation thing in general. I think most people probably know it, but actually, then again, making an assumption makes a you-know-what out of you and me and unction, right? And so you don't want to just assume that you're in this low or no. So your Social Security gets taxed, and it can. And the new rule changes from the OBBA did not make it go away. It just changed. It just gave a deduction.
that has nothing to do with Social Security.
Right.
So I mean, it's one of those, that created a whole cluster right now because people are confused of, I thought there was no time. Well, no, that was the intention. It never got passed.
That was
this
the
is
intention.
What's there.
Right.
It doesn't really have anything to do with Social Security. Whether you're collecting or not, you still get it. So.
Right. Yeah. So make sure that you understand that, Social Security it comes with taxation.
But so the interesting thing with Social Security and taxation, though, this is part of that bigger plan.
Okay.
Because the reality, when you look at how Social Security gets, how much of your Social Security is taxed, it's based on total income, and it's based on the percentage of your income that comes from Social Security effectively. So if you can shift your income where a larger portion of your income is coming from Social Security, and this is in general terms, right? This isn't meant to be planning advice, but just generally, if a larger portion of your income is coming from Social Security, just because of how that provisional income formula works, then you're possibly going to be able to reduce the amount of your Social Security subject to tax.
Okay.
So a lot of times the concept might be to delay Social Security, grow it, do conversions and things early so that later on when we turn Social Security on, now we have the possibility of actually reducing the amount of tax you pay on Social Security.
Gotcha.
And again, it doesn't work with everyone. So if you have a pension, chances are it's not going to work or not work as well because now you get this base level of income that's taxable. But
gotcha. Okay.
So Social Security, again, is one of those key pieces. Don't get caught up thinking either it's not taxed or, there's nothing I can do. It's going to be, 85% taxable. Mm-hmm. Potentially it is. There is.
Yeah,
There could be a lot of things you can do. And that's where it comes down to looking at this lifetime tax picture, not just today, not tomorrow, at my, RMD age, what does it look like? But what does it look like over lifetime?
Yeah, and looking at the whole picture, right, is the important piece. So the last one on this is don't forget to plan for your spouse and your heirs, again, to the whole piece conversation. While we might not feel the impact on, and I say we because I know I'm kicking off first, your loved ones will, right?
Right.
Yeah. So.
So I mean, in the picture, there's, again, lifetime tax. Part of that is not just taxes you might pay during your lifetime, but what's left unpaid because they don't go away.
Yeah.
So unlike other assets like houses or, investment brokerage accounts that get this concept of a step up in basis where the potential tax liability just goes away, that doesn't happen with an IRA. So that liability now gets shifted to a surviving spouse, the widow's penalty, and that's a scenario where that surviving spouse now is single, not married, filing joint. They've lost some income at a minimum, the lowest Social Security benefit. But chances are, if they've got all the assets still, which typically you do, you've named your spouse as the beneficiary, they can get pushed into a higher bracket even though they have less income. So it's one of those things you've got to look at that long-term big picture. It's going to happen at some point, and it doesn't matter which spouse it is. Typically, it's the same numbers, short of a pension. If there's a pension and survivorship, then that changes it. But anyways, you can't forget that piece of the picture. And same thing with your heirs, your kids. If you're leaving money to them, do you want to leave them this substantial tax burden that we really don't know what the tax liability is going to be?
They don't want you to. So.
Right. Well, they don't want you to.
Yeah.
And I mean, I get it. I hear clients all the time, well, if they get the money, that's up to them. It's their problem. Okay, that's great.
Yeah.
But if there was a way that you could reduce that liability, not affecting your current lifestyle today.
Why not handle it?
Would you be willing to do that, right? And the interesting thing that I always like to point out with clients is that, well, that's great, but that's if you end up leaving them the money, because everyone that I talk to, not everyone, but 99% of the people I talk to said, I'm spending it all.
Yeah.
So, and if you
or whatever's left they can have, but I'm doing what I want to do.
Yeah. But so if you spend it, well, then that liability that you thought was theirs is now yours.
Yeah.
So
true. That's true. That's
you have to look at that big picture and not look at the fact, or, just kind of discount the fact that, if the kids get money, they can pay the taxes.
Yeah. So, I mean, thinking about taxation as a new retiree, it's another element, a daunting piece of the whole new puzzle that is retirement. And tax mistakes in retirement are rarely about carelessness. They're just usually about not knowing what you don't know, So the good news is, Phil, these are avoidable, especially if you plan and you strategize and you work with somebody who's got the experience. So, at the end of the day, if you need some help, that's what Phil does. Reach out to him. have a conversation or talk with somebody, but make sure you're taking some action, especially as a new looming retire. If retirement's around a corner, do yourself a favor and be having these conversations with folks. Reach out to Phil at 248-888-7530. Numbers on the screen if you're happen to watch on video form, or if you're listening to audio, again, 248-888-7530. And don't forget to subscribe to us on Apple, Spotify, and of course right here on YouTube. Hit that thumbs up and notification bell. We have links in the description as well for you to click on if you want to go check out some of the, you want to check out the article, or if you want to go to Phil's website. All that good stuff is listed below. Phil, my friend, thanks for breaking it down, buddy.
Not a problem. Take care.
We'll see you next time on Phil's Tax Hacks and other retirement facts. And if you'd like to get some more information, check this out.
The Tax Smart Retiree is your comprehensive guide to mastering tax efficiency for a flourishing retirement. You will find indispensable advice and actionable strategies designed to enhance tax savings, maximize Social Security benefits, protect against market volatility, and develop a customized retirement plan. To get your free ebook, click the link in the show notes of today's episode and download your copy of the Tax Smart Retiree right now.
Investment advisory services offered through AFS Wealth Management. The content of this program is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. Investments and/or investment strategies involve risk, including the possible loss of principal. There is no assurance that any investment strategy will achieve its objectives.